All right, cool. Thanks everyone for joining. Really excited again, as always, to invite Andrew Hallam for a webinar. It's been a while that we haven't done one. We're now November 15th and already we're a bit maybe early to start looking at 2023. And I feel like a few people that got the invite would have been like, "What? Already a retrospect? There's still 6 weeks to go." But we felt a lot has happened already and a lot of lessons that we wanted to get together, have a informal chat around some of the biggest moments, trends that we're seeing, and leave enough room for Q&A. But first of all, thank you, Andrew, for always agreeing to join us and spread your investment wisdom.
Thanks, Mark. It's my pleasure. It's sort of early evening for you and super early in the morning for me.
Awesome. Yeah, we managed to always make it work. I also want to say thanks actually to everyone joining us from around the world, and already the fact that you're taking this step on an evening or morning to learn about finance on Zoom when a lot of people are a bit zoomed out or prefer to not to join the session as much, to still see hundreds of people signing up and doing that gives us a lot of excitement to continue to do them. So I really appreciate the engagement, and please feel free to leave your questions in the chat that we'll pick up at the end, just so that we don't interrupt the flow. So with that, just a quick intro, although he doesn't need an intro around Andrew. He's a digital nomad. He likes to write a lot about finance and lifestyle, and he's the bestseller author of Millionaire Teacher, Millionaire Expat, and also more recently Balance. So grab a copy of his book that you can order on Amazon in case you haven't. It's a really an amazing book that goes beyond just investing and tying it all together with studies around happiness. For those that are not familiar with Sarwa, we're one of the region's leading investment platforms. So we have a very similar mission to Andrew, which is to help people invest in a cost-effective, transparent way. And we focus a lot on the UAE, where we felt this is an underserved region. And we're backed by some of the top regional players and regulated here, which you can find more info on our website. But today isn't a promotional initiative, or we're not going to be covering Sarwa as much as investing in our mission to just spread financial education. Two disclaimers before we jump in. We can't tell the future. So this event is not about telling you what's going to happen next year or next week. In fact, if this isn't the first time you listen to us, we avoid and we call out people that try to forecast these trends, because we don't believe anyone can, and that our views are general. They're not one-on-one. And if you want more of a one-on-one discussion, this is best done with an advisor. All right, so Andrew, we'll get started. 2023 so far. This is the data that you put together very recently just to see where we are. What do you make of bonds or equities, or did this data surprise you in any way? It looks in general positive and a surprising year going into 2023 after a tougher year last year. But I wanted to see, what stands out for you when you observe the various returns on either equities, bonds, or globally diversified portfolios?
Well, I guess two things, Mark. One is that market returns of any kind tend to be really random, short term. And so, last year in 2022, we had stocks fall double digits and bonds did too. And global stocks are starting to bounce back. So you can see that global stocks are up just over 11%, including reinvested dividends calendar year to date. And the US market is actually up a little bit higher than that. So there's been a reasonably strong recovery. And you can see with the global stocks, when you're looking at the 3-year total performance, the 5-year total performance, the 10-year total performance, your risk really is reduced the longer that you own equities, the longer that you own stocks. And you can see that the longer the time frame, the stronger the growth. What we also get, though, is that a single year can dramatically impact even the performances over a 1, 3, 5, or 10-year period, especially when you're looking at something like bonds. So with bonds, last year was fairly unprecedented because we had inflation rise dramatically. And as a result of that, who wants bonds that are paying 1% per year or 2% per year? So many people sold their bonds. And what has happened is, as it always does, is there's always an oversell. There's an over amount of fear, or a little too much fear with respect to that, because people think really short term. And the nice thing about a bond market index is that with interest rates having risen, when a bond within an index expires, the index picks up a new bond. And now that interest rates are higher, those new bonds have higher interest rates. But, and this is the really cool part, Mark, they're not reflected in bond prices yet. So there's still so much pessimism. And that's why global bonds might be the world's best deal right now, because you can look at what 2022 has actually done to the 3, 5, and 10-year return of those bonds. But the lovely part is that it's probably the best discount going. And I'm not suggesting that people quit their equities, sell those, and jump into bonds. Bonds are just part of the diversification pie. So always ensure that you have those as part of your portfolio, whether that's a 10% allocation to the bonds, or a 30%, or a 40%. But one thing is for sure, now is not the time to say, oh, I'm going to dial back on my bonds because bonds haven't done as well lately. Just through the process of maintaining a consistent allocation, if anything, you'd be adding a little bit of money to your bonds based on maintaining this a consistent allocation, because bonds haven't performed as well. So you'll need to prop them up to maintain that same target that you had. So you can also see that, with the portfolio below, with a diversified 70-30, there's still positivity with that. But when bonds do rebound, and I know, you and I don't believe that anyone can see the future, and we know that nobody can. But what we do know is when an asset class gets beaten down, whether that asset class is real estate, whether that asset class is stocks, or whether that asset class is bonds, it's actually a safer point to buy them versus buying them when things are really rising. Like, not to suggest that we should ever time anything. This is just there for your own emotional calmness and own emotional equanimity. Just maintain a target allocation, stick to the course, and keep adding money as and when you have it.
Yeah. No, I think that's an important message, Andrew, because of their performance, and they're known to be more of the boring, steady, stable. And when they perform negatively, there's even more of an incline to ditch them altogether in people's portfolios. So to zoom out and to show and to frame them in the concept of a discount with the relative to where we are in the interest rate, or potentially in the interest rates, and how they can evolve is an important message. Awesome. And I think, based on that point where I think we mentioned sometimes a day can make a difference, I think just by coincidence, even yesterday, the market rose just on new employment data, on inflation data by 2%. So what can be a yearly interest sometimes, and we'll get to savings in a bit, we shouldn't underestimate what one day or 1 week can do to a portfolio while you hold steady.
That's a really good point, Mark. Yeah, and we're going to show that in a bit.
Great. So let's dive into the first trend. It's a really, really cool one that's been brewing for a while. So we're calling it FIRE gaining steam. FIRE stands for Financial Independence, Retire Early. And this is something that was also picked up by a global consultancy called Accenture that inspired us to really drill down deeper into it, where people are rethinking the milestones of life and crafting different paths. So not just with investing, but in general. They called one of the trends a decade of deconstruction, where people are really challenging the conventional path, whether it comes to career, whether it comes to relationships, and seeing if they really align with that, or if this is something that they inherited as a mindset from before. So before getting into finance, some of the statistics they shared is that people are questioning a university degree, marriage, moving out of parental home. So there's a lot of traditional milestones that are now being challenged, and especially with AI and the internet, um, there's a lot of people that are now, instead of dreaming of corporate stardom, are considering the online influencer, creator, innovator as an option, and skills-based hiring. So with all of that, how does this link to FIRE? I thought that FIRE was born 30 years ago from a book called Your Money or Your Life by Vicki Robin. And she was criticizing basically the consumerist culture. And she said, he who knows he has enough is rich. But Andrew, it sounds like after digging into it a bit more, the FIRE movement where people work hard, live frugally, and invest a lot, it's a bit more than that. So before we get into maybe some of the data around the FIRE movement, maybe it would be nice to hear from your own words. How do you define the FIRE movement?
I think, by name, the name FIRE is relatively new, like the concept of financial independence, retire early. But there have been people doing this for years, and in a lot of ways, it has gotten easier and easier to do it. Now, historically, when we look at how much of our income historically did we need to cover life's necessities in the past, like to just exist? And we needed in the past a lot. So,
Mm,
oh, thanks for that. Yeah, you can see in the 1920s, for example, the typical American spent more than 60% of their income just to stay alive. And then you can see that the graph where it's showing from 19 the 1920s until basically 1920, sorry, the 1900s to basically today, 2020. You can see how we require less of our income to cover basic necessities, less to keep alive. So we have a choice. We have a choice. And this is something that's been happening really slowly. People have had a choice to either ramp up their lifestyles and purchase things, or stay relatively the same in terms of how they're living, but then invest more money on, it could be experiences, but also invest more money into their future. So into possibly an early retirement, or putting themselves in a position where they just don't have to work full time forever. So it's interesting in that, I've had some neighbors years and years ago who, when I was a kid, retired, and they were in their 40s. And this was before FIRE had a name, and they were inspired by somebody else. So there have been more and more people doing this as our society has become more affluent. There just wasn't really a name for it. But then once it started to, people started writing books about it, and people started to talk about it online, and others are starting to say, wow, yeah, how do you do that? Like, I want to be able to do that. And then it really starts to catch on. But I still see, Mark, this sort of dichotomy here, in that you have spending, like general spending for so many people, in terms of where they're prioritizing it, in terms of understanding needs versus wants, and blurring that line, thinking that so many of their wants are actually needs, that we have to have these things. That makes it really, really challenging to build financial independence when you have lifestyle creep or lifestyle inflation. And this happens really, really slowly with people. And you get a new job, or you get a raise, or you get promoted, and people very, very slowly just adapt to that. Whereas people that are embracing the FIRE movement or the financial independence movement are saying, I just got a raise. Fantastic. Maybe I'll just a portion of that and improve my overall lifestyle with experiences, not things. So experiences, money spent on experiences enhances life satisfaction far more so than money spent on things. But then taking the majority of that, large portion, actually investing that for the future, so that we have financial independence, and then we have more choices for the future, and we have a whole lot less stress. So it's been happening for a long time, Mark, but it's really been building lovely momentum, I'd say, over the past probably 20 years.
That's really inspiring. But and when let's say we take you and as a teenager seeing your neighbors, would you say that was a model that you were following throughout? Because you achieved that same outcome without necessarily adhering to some of the extreme frugality or would you consider yourself as embracing that movement to retire, I believe at 38, or not
That's,
retire, but
yeah,
achieve
yeah.
independence? I'm curious around your own personal journey to make it um, to step out and make it more, I guess, personal beyond the data. Was that a model you were following throughout, or were you more focused on the income side of the equation rather than maybe the cost side?
Oh, that's an awesome question, Mark. I think what it did allow me to see was that it was possible.
Mm,
So it wasn't necessarily at the time where I said, I want to be like them, but I knew it was possible. And at the time, I was pretty young. And so, I was just like early teens. I was just a teenager, but I saw what could be done. And then when I was 19, I met a mechanic who was a self-made millionaire. And he knew that I wanted to be a school teacher. And he said to me, like, you want to be a teacher, and teachers don't make a lot of money. However, if you build financial literacy in your life, if you become financially literate, you can end up gaining financial independence far earlier than so many higher income people. So, yeah, as a school teacher, I didn't have a lot, but I had time because I started investing young. So I began, Mark, investing when I was 19. And I know that in the UAE, you have a full range of incomes. Some people earn massive incomes, of course, aren't paying taxes. In some cases, they have their housing paid for, and they're just socking away massive sums of money, like 70% of their income each year. But what I don't want is other people to get discouraged when they see that, because not everybody in the UAE earns like crushing levels of income. And I never earned crushing levels of income. But by my late 30s, I was financially independent, which didn't mean that I chose not to do anything, to sit on my butt. I still enjoy writing. I still enjoy speaking. So, and I'll continue to do these things. And I think that's really important too, but they're on my own terms. And so anyone who's listening to this right now who has, a relatively modest income, time is your greatest asset. So if you're young, especially like I was, you don't have to be one of these people who has the ability to invest 70% of your income, because in many cases, that's not possible. You're just not earning enough to be able to do that. So yeah, I think it's good to draw inspiration from wherever we can. And I'm hoping that I can inspire some people who are listening to this who don't necessarily earn buckets of money.
mhm. Yeah, I think that's a big part of a lot of your following is a relatable story and why a lot of the people are either reading the books or following the movement. I want to I want to look at this graph because my initial reaction when I saw it was a bit of the contrary to the message that you wanted to convey when we look at how inflation um, tracks towards the UK's house prices. Because the first reaction when I saw that, I was like, all right, well, it looks like the wealthy got rich, like the high net worth individuals are wealthier now. Um, but a big part behind what you're saying here was that, well, it's not just the wealthy that got rich, it's also the middle class. And so I'd love if you could share a bit more behind how you see this being linked to the rise of the fire movement.
Well, the dark line, first of all, you can see the graph. So I have two lines, and the dark line is inflation. So for this particular graph, I use the UK. But if you look at Canada, if you look at the United States, and in most of Western Europe, it looks about the same. But just for this one, I chose the United Kingdom. So you can see that that dark line is inflation over time. And traditionally, if we go back and look at housing markets in the United States, in Canada, and Western Europe, uh, traditionally houses, and this would be kind of surprising for some of you guys to hear, houses didn't beat inflation traditionally. Now, some years they did, and other years they didn't, but they more or less just rose along with like the rise in the price of your cereal boxes in the store. So that all changed. And I don't know whether that change is going to be a permanent change or whether that this is just a temporary change. But you can probably see from the graph that, say, from 1975 to about 1985, house prices in the UK basically increased along with inflation, as they had done just about forever. And then there's this bump up where you can see the separation between the green line, which is the average house price in the UK, and you can see how it rose so much faster than inflation again, which is that black line below. Now, take into consideration what we talked about earlier, where people are now using less and less historically, when we look decade after decade, less and less of their actual income to cover basic necessities, to just stay alive. So now people have a choice, as I mentioned, ramp up their lifestyle or invest it. And so suddenly we're at this point, this juncture, where we're not just talking about your primary residence rising in value, because I don't even really, Mark, consider that an investment, because it's an investment in shelter, but it's not an investment in cash flow. But it's where all of a sudden you had people that were spending less of their income on just keeping alive, deciding they're going to invest portions of their income in things like a second home. And now you can see how someone who's middle class all of a sudden is in a position where they can actually build a fair amount of wealth. So you're looking into that now, the 1990s, where these people are deciding that instead of buying a new car like their neighbors, or instead of filling their wardrobes with all kinds of clothes and eating out fancy coffees every single day, they decided no, they're going to allocate a portion towards their financial freedom. They're going to buy a second house. And so you can see how these middle class people were actually able to build wealth through that process and through that actual choice. And then that in itself is pretty inspiring. So you're 10 years into this now, your neighbor is going like, how do you do this? Like, wow, you're an accountant or you're a school teacher. How is it that now you have the second home? And wow, look at the price appreciation. I've never even thought like this. I haven't thought like this before. How do you do this? And so it's cool in that it encouraged, or it has encouraged, other people to do it. And that's been part of what this FIRE movement's been about. You've seen people do it, and now they're encouraged to do it. People that do it are proud to start telling you about it. They'll start writing books, they start writing blogs. I mean, the internet was a really big boom for this, Mark, because now they're sharing their stories and they're sharing their how-tos, which is pretty cool.
And how much of these, that's really cool. And I think that's it's a nice message, because it's easy to look at this chart and feel intimidated that you missed the boat, or as you said earlier, to feel like my job or my income might not match. But this is another push towards asset ownership in general. But a lot of this content that's come up, how genuine is it? How much of this is tips and tricks, and versus how much real depth is there in the FIRE movement? Or is it just enough that people are finding out about more real stories from their neighbors, etc., to craft their own path?
I think more and more people are recognizing the importance of money as a tool, and seeing that there is a different way of living. And that different way of living is that if we're spending less on material things, and that material things don't really boost life satisfaction, and people are starting to get that. I mean, we've seen the research on that. If I buy a new car, I have a car out there now, and the car works just fine. And it's pretty old, but I think it's awesome. If I bought a new car, it would be a bit like a sugar fix. I'd be excited in buying it. I'd be excited to drive it for the first few weeks, but after a while it just becomes a car. Therefore, doesn't really increase my life satisfaction based on hedonic adaptability. I simply get used to it. People understand that now. I think more and more people understand that. I'm not going to say everybody understands that, Mark, but I'm going to say more and more people are understanding that. They're seeing the science behind that. They're listening to people who are speaking this language, and more are getting inspired to recognize that money really is a tool. We spend it to enhance our experiences. We can spend it to, well, we can invest it to reduce our stress and to give us more choices in terms of things that we may be wanting to do. Take a year off, decide to travel the world for a while. Your job is stressful, let's say. Well, you might not need it. You can quit working for a year or two, or take a part-time job that you're passionate about, something that's a lot more fun, or volunteer. I think more and more people are starting to get this, Mark. And I'm not saying it's the majority for sure. I think the majority is still kind of trapped at a hedonic treadmill, and they're still trying to keep up with the Joneses, and they don't even really recognize they're doing it. I think the majority of people haven't differentiated between asked themselves this super hard question where they differentiate between their needs and their wants, because people generally tend to be sheep. We tend to follow the norms of the societies that are around us. But this movement is gaining momentum, Mark, and it's pretty exciting to see.
I totally agree. I would add, I found this really cool. It's gaining enough traction that now you have almost subcultures within it, where there's 4 terminologies around lean fire, so those that are embracing minimalism. There's coast fire, where people save up a lot early on, and then that nest egg that they've built is the one that's going to be serving them during retirement. So all of their expenses go towards expenses and they don't need to save anymore. There's barista fire, so people that acknowledge that they still want to do work, but on a part-time basis. There's fat fire, so this is people that are generally earning a lot and don't want to compromise at all on lifestyle. So it's interesting to see like all the different variations that this is developing. But I wanna ask you, because I joined the Reddit, some Reddit communities, and I realized a lot of these people, some of them might not be as happy as what I expected, and might be undergoing a bit too much stress to get to a number versus, as you're saying, to put money, use money as a tool. So I wanted to see, this all sounds great, but where do the fire devotees, where do they miss the mark, and what are some of the dark side of that you've seen on either the Simplify group or any other communities that you're seeing where this is being embraced?
Yeah, that's such a good question. I'm glad you asked that. It's something that I addressed indirectly anyway in my book Balance. And it's the idea that people will believe often that if they don't have to work, or they decide they're going to quit their jobs and not work and be officially retired, that's going to solve their life's problems. It won't. They'll still have many of those same problems, whether they're social, relationship wise, or whatever, or physical. The important thing, and one thing people really miss the boat on, I think, Mark, is that we need to work. So we need to keep busy. We need to keep active. It helps us socially. It helps us cognitively. People who are active in the community, and generally when we're working, we are active. So when you go to work, at Sarwa, you see your colleagues, you see your friends, you're talking to each other, you're challenging each other. This is all really important for human development and human maintenance. The idea that we do nothing at all is essentially leads to an early death and an increased probability of Alzheimer's and dementia. And I say that, and somebody listening to me might say, well, that's crazy. What's he talking about? No, actually research on this, that people that retire early typically like fully retire. If they fully retire, their mortality rate increases versus people at the same age, same level of physical health. So when we isolate those variables, people that work longer actually end up living longer. Okay, so knowing this is really important, because I'm not suggesting that you have a job, you hate it, you should continue to do it until you're 90. What FIRE does for me, and when you really nailed it, is, let's say you have a job and you're not really enjoying it. What this does when you get towards FIRE or even coast FIRE is you build enough assets such that you have a choice now. You have a choice to dial back and perhaps do a job that fulfills you. It may pay half of what you're getting paid previously, but it keeps you active, keeps you learning, keeps you social. It gives you some fulfillment. Even in and out of work is fine. Like taking 6 months off and then maybe going into travel, or just you could write a book, or just devote it to visiting a bunch of old friends that you have missed, neglected, or haven't connected with for a really long time. Just to have that choice is important. But the idea of FIRE, Mark, or financial dependence, just to sit on your butt and retire forever at the age of 40, that's where people really are missing the mark, because it does lead to a lot of misery and a lack of purpose for people. And purpose is a really big one. In Balance, I talked about the important aspects of success, and success really was happiness. And obviously we need money, and we need relationships to be solid. We need our health, and really importantly, we need a sense of purpose, that thing that gets us up in the morning. So we don't want to build or have the goal of building a massive nest egg just so that we can sit on our butts and never do anything again.
I love that. I would also add, one of my favorite things about this movement is, I think the wealth management industry suffered a lot from anchoring to the $1 million mark or the $2 million mark, or that number that can cause sometimes more. It can feel like basically that you're far from that number to reach. But what I found is influencers like Money Mustache say the most important number is your savings rate, actually. Last month, how much of your income are you able to put away? And I feel like that gives a lot more control and puts it as a tool, as you said, as opposed to anchoring on a certain number. Would you agree with shifting away from $1 million mark or a certain amount of expense, or do you find that that's actually a good goal to have and can be a compass for people?
Yeah, I think control what you can control, and I think he's right. If you can control your savings rate. You can't necessarily control how the markets are going to perform this year or 10 years from now. So that $1 million mark, you may achieve it a lot sooner than you think. It might take longer than you think. And if it takes longer, you might beat yourself up over something that you can't control. And this is something that's so important just in life generally. Accept what you can't control and control what you can control. So if you can control your savings, which we all can, then go ahead, go for it. But in talking about that too, I think the idea that you live in misery just to save money for some time in the future is another mistake that people make when they're trying to achieve FIRE. I suggest that, yes, be frugal. You don't need to spend money on material things, but allow yourself to spend money on experiences along the way, because life is incredibly unpredictable. One, any of us could be gone. It doesn't matter how young you are. We might only have 5 years left. So we want to make sure that we have one eye on today and one eye on tomorrow, that we enjoy our daily lives, and that when we are spending some money, forget about upgrading things and buying stuff, but spend it on actual experiences. Spend it on people. Be with people. Charitable giving with people, and that's the most important aspect.
Love that. I think I get the more and more why you named your last book Balance as we dig into these concepts more, because it's easy to lose sight of the most important things. I'm gonna skip this part. This was just a demo around a free tool we built around a retirement calculator where you can play around to see if you want to retire 5 years earlier, what would it take, things like that. But you could check that out if there's a lot of tools also available that are similar. Um, let's dive into high interest rates. It seems like we went from a decade of not hearing about interest rates to now everyone's just literally talking about either inflation or what and how that's going to impact how interest rates are going to behave, and it's almost overcorrected. So I want us to dig into that because for a lot of us that have been investing, they've been quite low, and now we're hearing of higher interest rates. So a lot of people might scratch and start to say, okay, well, the conventional wisdom is that the interest rate is for a down payment or 6 months of expenses, short term. But when I start to see higher rates and a lot of advertising going into that as well by some of the banks, it's tempting to say, Andrew and Mark, they often say you can expect potentially 7%, 8%, maybe double digit on a good year. Why would I, when something is guaranteed? If I look at, we have a lot of Indian clients and a big Indian community in the UAE. If we look at the historical savings account interest rates in India, interestingly enough, it's almost at 7% now. So why would I take a chance to make a 7% on roughly on a globally diversified portfolio when a bank is offering close to that? So would love your take on it, on if you've seen, for someone willing to take maybe some equities out and putting them into savings, what do you think of that idea? And especially that it seems something that we've dealt with a few years ago as well.
Yeah, it's something that you mentioned the idea of having money in the savings account to cover 6 months worth of living costs, which is really important. Now, that's a great purpose for a savings account. Also, keeping money in a savings account, it's liquid, that you're saving for a down payment on a home. Again, that's really, really important to be able to have that too. But in terms of deciding that you're going to move some of your money into a savings account as something that you're going to hope will enhance your future retirement is a really big mistake. The one thing when we're looking at, so interest rates in India, for example, a savings account, most of these are not in US dollars. So you and I talked about this, I think, a year ago, a couple of years ago, where you could actually show the interest rates on savings accounts in India were high, but they were in rupees. And so as a result of that, we actually had the US dollar significantly outperforming the Indian currency. And as a result of that, in USD, they actually lost money because the currency dropped further and harder than the US dollar itself. So that's a major risk. If somebody is Indian and they're saving for a down payment on a home, for example, and it's earning them 2% in US dollars, or let's say someone has done this over the last decade. They've been, saving for a house, they've put their money in US dollars. Let's say their savings account has been making them 2% versus an Indian account earning 7 in rupees. They've actually made more money in the 2% account in USD than rupees. So it's something that we should really be cautious of too when we look at especially savings accounts that are in foreign currencies, because those currencies can drop and they can drop pretty hard. So that's important to remember that. It can be a little bit of a mirage when we're looking at interest rates historically in India and how much money people would have made in them, because ironically, over the last decade, you would have made more money in a general savings account in the United States or in Canada or something in a more stable currency than you would have in India, even if that interest rate in Indian rupees was like 6% or 7%. But then there's that other aspect too, I think, Mark, that I think you're probably going to be leading into here, and it's that markets can move so fast. And so even if you find, oh, there's an account in the UAE and it's offering, 6% interest USD, I'm going to put my money in that because bonds are low and wow, 6%. Well, that's pretty good. Things change so fast. Number one,
Mm-hmm.
interest rates on these savings accounts often change really, really quickly too. So they can drop, you get in there, you think that you're going to get 6% or 7%, and then suddenly you find that interest rate at some stage just drops. And then there's the element of, well, what is the opportunity cost on that? And so when you decide not to invest in a globally diversified portfolio of index funds, which has majority of equity exposure or known as stock market exposure, when stocks jump, it reminds me a little bit of what Warren Buffett says. You only know who's swimming naked when the tide goes out. And that would
Mm-hmm.
be people who are putting their money into savings accounts right now.
Mm-hmm.
High interest savings accounts for their future retirement spending, I'm talking about. Thinking, I don't want to put it in my stock and bond market portfolio because, maybe performance hasn't been that great over the last couple of years. But as we've said before, market movements can occur so quickly, and we don't want to be caught with our pants down on those. So yeah, here are some classic
Yeah.
examples. Um, and I brought this data, Mark, just to show this was just during my lifetime. So you can see,
Mm-hmm.
it started in 1971, and you can see the number of years where the global stock market earned huge returns and quickly. And in a lot of cases, Mark, a lot of these returns, or the majority of these returns, could have been earned in a single week. So you
Mm-hmm.
look at 1971, where it says, the global stock market increased by 18.5%. That wouldn't have been a gradual linear gain of 18%. That the bulk of that gain could have actually occurred in a single 10-day period. And if during that 10-day period, somebody has their money in a savings account because they don't trust the stock market, they can lose out big. Look at 1985. Global stock market increased by 51%. And again,
Mm-hmm.
a big portion of that could have just been a couple of weeks. So yeah, it's a mistake to put our retirement savings in a savings account.
And that's the reward for sometimes taking in years like last year, which were negative. And of course, there are negative years, but that's the pain that's compensated by that upside. And we lived it actually. We see that a lot with Sarwa clients, where a lot of the time we'll hear people that started within 2020. 2020 was a very interesting year because I think we even did a webinar close to March, April, where the market went up 10% or 11% in a day. And usually we would have like two friends saying, my Sarwa return is X, and this person says Y. You're like, how
Mm.
come your return is so much better? And the answer, I've just gotten used to asking them, well, when did you, which month did you start in 2020? And if you had missed these couple of days where it did plus 10% or something crazy like that, it can make or break your return of that year. So, and it's very easy to get that return if you're invested versus because you don't have to do anything. You have exposure to it. Um, just conscious of time to leave in room for Q&A. The last topic is it's something that we even debated if you want to even get into because it's a tough one. There's a lot of difficult to feel sorrow with a lot of the events from and a lot of the wars globally from Palestine, Israel, from Russia, Ukraine. So and we're privileged to even be able to talk about today. Um, okay, well, how does this impact a portfolio? But I do have some people that have reached out and have said, okay, there's a lot of unrest, there's a lot of conflict. It seems like even every 18 months, there's World War III that's trending. It's so easy to get into a panic state and say, what if this escalates? What are we? Should I be doing anything? And does this change anything? So I wanted to get from your opinion, Andrew, on this. When you see so much unrest, and especially the news that's really covering this in a very, very intense manner, What do you make of that when it comes to investing, and what should people be doing, if anything, when they see that happening and unfold?
Well, the risk here, Mark, is that the natural inclination is to speculate and to decide when we see something horrific happening in the world to pull our money out. So whether that was during the pandemic, which would have been a really big mistake because in 2020, the stock market ended up with a solid double-digit gain when the world economically had basically shut down. What that goes to show is that the stock markets short term are so unpredictable that we can't really look at a global event, whether that's a war or an economic event, which COVID-19 caused, and predict what's going to happen. And so, we went back before, Mark, to the idea that if you pull your money out, sometimes for even a week or two, you can miss the biggest gains of that year. And historically, when we look at conflict, in terms of armed conflicts as it relates to the stock market, it's weird, but it's as random as any other day, which is really strange. So I think we have a slide to actually show we're talking about human progress and the markets, they go on. They tend to sometimes pull back, but we never know when they're going to pull back. And human progress is a lot like this too. We do and are making progress, but we have slip ups. We have still wars. We have still issues to deal with in terms of climate change problems. But when we do look at the stock market during periods where there have been wars in the past, you can see that it's incredibly random. It's as random as any other day. So on average, markets increase during about 60 to 66% of calendar years, markets actually increase. So 2 out of every 3 years, you'll see an increase in the markets. That's not to say that it runs like, well, we've had 2 years of gains and we're going to have 1 year of a decline. It's totally random. It's just that on average, 2 out of every 3 years, markets end up rising. And when we throw in armed conflicts, when we throw in wars, you'll see generally the same kind of randomness. So if you look at World War I and you look at, when World War I actually broke out, and then the fact that, it's so weird to think, but like the markets actually rose considerably during World War I. It started in July 2014, and you can see that global stocks or US stocks increased 14%. Beginning of the Spanish Civil War, July 1936, stocks up more than 11%. World War II, well, 1 year after, stocks dropped 11.99%. So the numbers I'm giving you are just like the 1 year return rates you can see in that first column. Korean War started June 1950. That year, 12 months later, US stocks are up 23%. Vietnam War started November 1955. Stocks increased 5.72%. This isn't to say that war is good for stocks. It's just, it's random. You'll see that there are times when the markets dropped, or were lower 12 months after a war had begun. But I think the most important part here, two important parts, Mark, is that one, it's totally random. Two, markets rise more often than they fall. And okay, let's add a third. The longer you're in the market, the lower your risks actually are. So, when you look at the returns of the market 5 years after each of these armed conflicts began, you see a positive return for all but one of them. And that one would have been the Spanish Civil War in July 1936. So it just happened to be that 5 years later, the stock market was still down 13%. But again, totally random. And I think the most important part here, Mark, is don't speculate. try to stay calm and control what you can control.
Yeah, I think that's which again, we try to always highlight the positive in a tough situation where we wanted to show some progress or a lot of reasons to be hopeful, and the resilience behind I guess our species. And I know you mentioned Sapiens that talks a lot about that. Um, before we close this topic, this chart before reminds me when as you said, during COVID, we looked at previous pandemics and showed a very similar finding. But what do you say to someone that says, well, now this time is different? There's people like Ray Dalio that are often showing the chart of the US losing its power, and there's a new world order that's trending. So what do you say to the classic argument that you probably heard many times of, well, this time it's different. Fine,
Yeah.
but given what I'm seeing on the news, etc., it has a different flavor to it.
You know, every time is different, and I think that's something that we need to recognize. One, we have really short memories too. Horrific things and frightening things have always happened, and it's always been different. Like in the 1980s, you know, it was different that mortgage rates or interest rates had risen so high that if you were to borrow a house, your mortgage rate would have been 18 to 20% interest on your home loan. You know, that was different. That had never happened before. You know, 1973, 1974, we had Americans waiting 2 days at gas stations for fuel, like there was a major fuel crisis. That had never happened before. And that's what history really is. It's just a whole revolving door of things that have never happened before. Mark Twain says, history doesn't repeat itself, but it rhymes. And it does in a lot of ways. So I think the idea here is just in recognizing that, and also recognizing that we need to control what we can control, which brings us back to, if it's our monetary, if it's a financial thing, that's our savings rate. If we can control that, control it. Try to control our emotions with respect to our money so that we don't end up speculating and looking at world global economic events and basing financial decisions on those, because every time is a little bit different. And we shouldn't start thinking that this time is particularly unique and that we or someone we know can speculate and determine how the markets are going to go. And then I think most importantly is, you know, helping people when and how we can.
So Andrew, let's end on the presentation here, and we'll take a few rapid fire questions, and if there's anything that we aren't able to answer, we'll try our best also to reach out individually. I'll start a question from Han. What would be Andrew's advice for someone starting late at 50 years old and have 10 more years before retiring?
I think, Han, that's a good question. The idea that, one, take comfort in knowing that you're never going to be younger than you are right now. And so starting right away is really important. But don't put so much pressure on yourself, Han. In terms of wanting to retire at 60, historically, I mean, retirement itself is a really new concept too. It's not something that was, you know, it's a 50-year-old concept, which is relatively new. People didn't used to retire. I'm not saying that you won't be able to retire at all. I'm saying don't put an age thing on it. Like, don't say, oh, I'm just starting now and I want to retire when I'm 60, because that puts so much pressure on you. And what I think you could do instead is to say, Han, maybe at 60, your goal might be to dial back and work part-time, because there's such a huge benefit to, as I mentioned earlier in the webinar, to maintaining some kind of social connection with people, and a lot of that process, I mean, on a professional level, keeps you learning, keeps you thinking, and alleviates a lot of financial stress because it brings you a little bit of money as well. So that would be my response: is not to be so hard on yourself with respect to a hard and fast date at age 60 where you're deciding that you're not going to do anything from that point forward.
That another question that's really good from an anonymous attendee. With the growth of AI being so obvious, why is it still not advised to invest directly with NVIDIA? They have had super growth in the last 6 months alone. Why favor index funds when your potential returns with AI companies is far greater?
It's to answer that question, what happens when we all know that, and so as a result of us all knowing that, the price to earnings ratios end up rising with such companies. And the most solid long-term stock market returns actually generally don't necessarily come from growth industries. And that surprises a lot of people. It typically, when we're looking at different countries and we're looking at a whole multitude of decades, rolling decades, different time periods, different markets, it's often the unexpected that actually gives us the best returns and not the expected. So with the AI industry, we all know that this is massive. And so as a result of that, price to earnings ratios are significantly higher, and the odds of their long-term returns aren't generally as high as the markets themselves. Now, I'm not saying that that's what's going to happen. It's not a prediction, but I'm just looking at long-term economic science. Historically, that's been the case. So that's why I would suggest stick with a portfolio of index funds, just like I'm suggesting that Han does too. And then Han too, if you were asking or looking for an actual answer to that question in terms of what you were to do in terms of your investments, keep a globally diversified portfolio and just keep adding money to it.
I would also add, NVIDIA would already be in your portfolio of index funds because it would have reached a big scale. So don't feel like you're missing out from its exposure. It actually already contributed to your great performance this year. So it's not an or, you already own it. It's a matter of how much exposure do you have to it, and you need to double down a lot more, and the magnitude at which you have exposure to AI. And the winners today might not be the winners tomorrow. We see so much shuffling in the top S&P 500 companies, for example, that AI could still very well be executed really well and become the next big thing. But it's a matter of will these players of today be the ones that actually win, or will they be outcompeted? And you wouldn't need to decide or predict that if you have exposure to a broad-based index, because it'll always pick up. Not always, but depending on, let's take if you have exposure to the biggest and smallest companies, like an ETF like VTI that has 3,000 US companies, it'll end up in your portfolio without you having to lift a finger.
Exactly.
This one I think we already covered, but in case you want to add anything to Saeed, he's saying, considering the S&P's long-term follows the US economy's growth, with many geopolitical global stresses on the US economy, especially from China, will the long-term forecast stay positive?
Well, nobody knows how market returns will be going forward for any given market. And this is why it's best to diversify. So there are always going to be markets that outperform others, but nobody is going to know in advance which those markets will be. So, we can sometimes look at even historical GDP levels and see, wait a second, there's a country or several countries in Southeast Asia where GDP, for example, was phenomenal, but stock market growth wasn't as high. And then wait, there's the United States and the UK, and they had slower GDP than China, but they had higher stock market returns than China over the last 20 years. It's really, really unpredictable. And so you can't really determine how well a stock market is going to perform based on the economic machine, especially short term. And short term can really be 10 years can be short term. And so my suggestion is to maintain a globally diversified investment portfolio so that you own everything. You own the world. You own the AI companies from the US and from the Middle East, and you own, the tech companies, and you own the retail firms, and you own, real estate businesses within those. So own the world at the lowest possible cost and keep adding money.
Andrew, I think, Omar, that answers your question about just honing in only on the US versus global diversification. That's why while we do show the S&P's performance, sometimes for simplicity, we try as much as possible to cover, similar to how we've done in the beginning of this presentation, a global view, so that you don't have to be worrying about shifting powers. There's a question that I think is really cool because it's specific to bonds, which is it's great to see bonds getting more interest. So what are the pros and cons of an individual bond versus a bond fund, which would normally provide interest payments?
Yeah, generally diversification, number one. So if you have a bond index, you have a whole variety of bonds within them. And let's say you have an individual bond. There's an added level of risk with an individual bond because let's assume that it pays 6%, and it will pay 6% for a given term. So let's say it's a 5-year term, and you give your money, you will earn a 5% return. At the end of the 5 years, you'll receive your money back. But what if year 2 into holding this bond, inflation increases to 8 or 9%? In that case, your actual bond will drop in value. So the only way for you to get your money back is to hold it for the entire term. And you would have inflation actually outstripping your bond interest. Now, if you have a bond market index, especially one that's a shorter term or a broad term bond market index, not one that's just filled with long-term bonds, what happens is you end up getting a series of bonds that when they mature, the provider will pick up a new bond, and if the interest rate is high, a new bond to replace those that mature within your index. And if interest rates are higher, inflation is higher, then the newly issued bonds will have higher interest rates internally. And so you might not see the benefits of that right away, because I did show you earlier on how bonds still haven't performed well even since 2022. They've dropped, but the actual value of it is there. And so what will happen is you will get a recovery, and that recovery will be very, very strong. And so again, we don't know when, we don't know how, but those are the two reasons why it is generally better to go with a bond market index, especially a short-term or medium-term bond market index, than to purchase single and individual bonds based on risk.
Last one, and then the rest we'll take offline, just to respect Andrew's time and his morning. A question from Nizar. As part of retirement planning, is it enough to invest in indices, or do you need to pick individual stocks to achieve your goals?
It's enough to stick to a globally diversified portfolio and not to pick individual stocks. Once we start getting into individual stock picking, we become active managers, and the statistical long-term evidence is such that most people that try to pick individual stocks end up underperforming long-term the index funds that are within, that those stocks are actually within. So there's an added level of risk in that long-term, your stock picks long-term, the odds of them beating the stock market index are extremely low. And when you do start to put individual stocks into your portfolio, you end up with a concentration lean, thereby reducing your level of diversification, not increasing your level of diversification.
Thank you, Andrew. And yes, sir, I think that answers your question of going with investing or trading. as our initial or recommended route. And with that, Andrew, thank you so much for another amazing session. Always a pleasure. And hope that the next one we'll aim to do in person. So as a quick sneak peek for what's to come with something that we're preparing, and we'll keep everyone posted when that happens.
Thank you so much, Mark. I really appreciate it.
Thank you, Andrew. Enjoy the rest of your day.
Thank you. You too.
Bye, everyone.
Bye-bye.